Hey guys, welcome back. This is StockBroc. Today I'm breaking down the role of the Fed. How do they control rates? What do they do? And what's the recent rate cuts mean for the stock market, your investing returns, and whether we're really dodging a recession or stagflation? So to dive right in, we're going to talk about what the Federal Reserve, the Fed, is America's central bank. Its main goal is keeping prices stable, controlling inflation, and supporting strong job growth. What's called its dual mandate. It's required, and its whole job and responsibility is stabilizing the dual mandate, which is basically prices staying stable, controlling inflation, and supporting strong job growth. It influences the economy by regulating banks, managing the supply of money, and most importantly, setting interest rate targets, the cost of borrowing money. How does the Fed control interest rates? The Fed sets a target range for the federal funds rate, which is the interest rate banks charge each other for overnight loans. It moves the rate up and down mainly by buying or selling government bonds, adjusting liquidity in the financial system, and influencing the rates banks receive on reserves. Raising rates makes borrowing more expensive, as we've seen over the last couple years, year and a half or so. Borrowing money and mortgage loans have cost us as consumers more money, is why people aren't buying as many cars, people aren't buying as many houses. We're technically in a housing recession. But basically, raising rates makes borrowing more expensive, which slows down consumer and business spending. So a lot of the smaller businesses aren't spending as much because they have to borrow at a higher rate. Lowering makes borrowing cheaper, which they did today. They cut interest rates by 0.25, which encourages spending and investment. And that is why the Russell, the small cap index, was up today. What do rate cuts mean for the stock market? When the Fed cuts rates, it's usually trying to support the economy during slowdowns or low inflation. Borrowing becomes cheaper, stimulating growth. So more people are spending money, people aren't spending as much on their mortgage, people aren't spending as much on their personal loans, car loans. They're able to put more money into the economy by buying things, going to restaurants, going to the mall, buying cars. For the stock market, rate cuts have several effects. Companies can borrow at a lower cost with the lower interest rate, making expansion and investment more attractive. They're able to invest in the business more and borrow money more to also invest in the business. Investors' sentiment often improves, boosting demand for equities, so more people are willing to buy equities in a cutting environment, because bonds and cash yield less. So they want to make money elsewhere because government bonds are paying less, and your yield on a savings account or short-term bonds are going to be a lot less. So heading towards below 3% is the path we're on. Lower rates can lift stock valuations. Future profits are discounted at a lower rate, so prices for everything from tech to housing often does rise. Historically, stocks have produced stronger returns in the months after rate cuts, although the benefits may already be partly priced in if investors expect easing. So the market's already been rallying quite a bit, but we could expect some small caps to rally even more. So this might be the rotation of the stock market, where people are taking their profits from the large companies, the big tech companies, and rotating it into the smaller companies. So one rate cut doesn't mean much, but if we're on a clear path where there's a lot of certainty, then this could be really good. And we do have to keep watching the data, because that's how the Fed is going to react. Does this mean we're avoiding a recession or stagflation? Not necessarily. Rate cuts are a positive signal for growth and may help steer the economy away from recession if there are no severe external shocks. However, if inflation is still elevated while growth remains weak, the risk of stagflation arises. High prices with slow growth or negative growth. So stagflation is still definitely on the cards, even though that we're cutting rates, and after rate cuts, the stock market does end up producing better returns, but stagflation is definitely still a concern because we can have higher prices with slow to negative growth, and then jobs market starts to worsen, which is definitely a risk. The Fed's challenge is finding balance. Cut too much and risk reigniting inflation, tighten too soon and risk triggering a recession. So if they would have cut 50 basis points, the stock market totally would have went down because of the risk of inflation coming back. The goal is 2%, and we're closer to, I think we're over 3%. So we're not necessarily at the goal, and now the Fed is saying that we're going to hit the goal in 2028. So just a little concerning because we were supposed to hit the goal this year. Investors should always watch underlying data such as the jobs data, wages, inflation, even when the Fed offers relief through rate cuts. The Fed's rate decisions ripple through every corner of the market, but there are no guaranteed outcomes. Stay tuned for StockBroc to break down any stock market related updates, how monetary policy is shaping stocks, sectors, and your investment returns. This is for education, not financial advice. Thanks for watching. Peace out.